So what exactly is interest? Now please think of borrowing money. Now what will happen when you go to someone or go to bank and say I would like to take a loan? Now what will the bank do? I'm sure you know that the bank is going to charge you interest. Now in fact, if you look at it, the bank also borrow money from you. Now you're going to say, I don't think the bank needs to borrow money from me because I am so not as rich as compared to the bank, and why would the bank wants to borrow from me? Now, but think and see, when you go to the bank and you open up an account and you put money in that account, now you realize or not what the bank is doing? The bank is borrowing from you. That's why the bank is paying you an interest when you place money with the bank, because you're lending money to the bank. Now, so every time when we borrow money, when someone use your money for a period of time, in exchange for that, you'll be paid interest. Now, we would look at what is the concept called simple interest, and then later I'll bring you to what's the concept called compound interest. Now, let's say if you're going to put 10,000 ringgit in an account that will give you 3% interest for a year. Now, how much interest will you make after 1 year? Now, if you take 10,000 times 3%, you're going to make 300 ringgit. So if you're going to withdraw this interest, you take out the 300 ringgit and you're going to spend it. How much interest do you think you will earn if you keep taking out the 300 and spend it after 10 years? It's not a very difficult calculation, right? So if every year you're going to make 300, so after 10 years, you're going to make 3,000. That's a simple interest. So I'm going to introduce a concept called compound interest to you. So if you're going to deposit 10,000 ringgit with the same 3% interest as your return rate, but the difference now is you're going to reinvest the interest. So what happened is you're not going to withdraw the 300, you're going to leave the 300 with the bank and tell the bank, keep the money and invest it again and pay me another 3% on top of all these things. So how much will you earn after 10 years? Now imagine the first year you're going to get 300. So after the end of the first year, you're going to get 10,300 and you're going to keep that for year 2. So another 3%, you're going to get 10,609. Then you use that 10,609 and keep it for another year. So in the third year, you're going to get 10,928. So the formula is based on the capital that you put in, and then we multiply by 1 plus R. R is the rate, and N is power of the number of years that you're going to compound the interest. Now we're going to use 3%, so it's going to be 1,000 times 1.03 power of 10. So at the end of 10 years, you see that you're going to get back 13,439. So by not spending the 300 ringgit every year, after 10 years, you will get back 3,439, compared to in the simple interest situations where you spend the money every year, you only get back 3,000. So what's the difference, guys? The difference is you have made 439 ringgit more. That means by not spending the money and leave it there and let it earn interest, you actually made 15% more return. Now you're probably going to say this, it's just 439, is not a lot of money. Yeah, but you have to understand that interest is a relative terms. Relative terms means it might look very small because the amount is small. So 15% of 3,000 is just 450. Yeah, it's not very attractive, it's not very big, but 15% of 1 million is 150,000, and that's a lot of money. As you grown up, you will have to buy houses, you have to buy cars, you're going to make more money, you're going to leave money in the bank, so you're going to come across things like loans and savings account. So it's good for us to have an idea about how this works, right? Okay, so when you go to bank and ask for a loan, let's say you want to buy a house, you're gonna get a mortgage loan or a housing loan, you will see most of our banks will quote their interest using jargons like BR, BLR, or BFR. Now I'm not going to explain to you exactly what's all these acronyms mean, but I'm going to tell you like BR is their base rate, their base lending rate, their base financing rate. So this is how our government control their overnight policy rate, OPR. So it's one of the way of how government control interest rate, and it's one of the tool for the government to control money supply, and it's also a tool for the government to control various things like the strength of your currency, how do you want to deal with inflation and stuff like that. Now you can see on the screen that the government has in very short time, right after 2022 until now 2023, been adjusting our interest rate. So it was quite low at 1% and now comes to 3%. And the question is in such a short time. So that is the issues that we're seeing. Is it such a short time that the government is doing this adjustment? Now the meaning is those people who has been borrowing a lot of money will start to feel the pinch that they have to pay more to the bank because the cost of the loan is getting more expensive. Now, so let's say if you go to Maybank and you open up a basic savings account, now how much interest will the bank be paying you? Remember I said when you leave money with the bank, you are actually lending money to the bank. So when the bank borrows money from you, the bank pays you interest. So you can see a very miserable amount of interest that if your deposits with the bank is just between 1,000 to 10,000, they're just paying you 0.25. Like it's not even 2.5, okay? It's 0.25. So how much interest that you're gonna get if you leave 1,000 ringgit with the bank for a year? Just take 1,000 times 0.25%. It's that miserable, okay? So if you really want to save money in the bank and you want to make a little bit more, what you have to do is to go for something called fixed deposit account. Now, why is it called fixed deposit? Because you basically tells the bank that I'm not going to take the money out from the bank for a period of time. So generally, if you place money with the bank for 1 month, that means you're not going to withdraw the money for 1 month. You have to take note, if you withdraw this money even a day before maturity, you're going to get no interest whatsoever. Zero. So let's say if you're going to just place your money with Maybank for 1 month, your interest is 2.6%. So guys, do you have extra money that is left in your drawer, maybe from your ang pao or duit raya? You know, you could have got some money that you've left there and then you didn't do anything with it and you just leave it there, but might as well you just go to the bank and put it as a fixed deposit account and you're going to make more interest, and it makes sense because the money is going to grow rather than you leave it in your drawer. It's not going to grow. And notice that the interest rate that Maybank is paying you is higher when the fixed deposit tenure is longer. So if you go to the bank and say I want to open a fixed deposit from 6 months or to 12 months, you will see that the interest rate will go up to 2.8%. So the reason why the bank is willing to give longer to you is because the bank is sure that this money that you give to the bank, you allow the bank to use it for a long period of time. So the bank will be able to use your money to make more money by giving loan to other people. So the bank is able to pay more to you. As a result, the interest rate is higher. So the saving account's interest rate is so miserable, but the fixed deposit account interest rate is so much better. Now, this is when you have money and you place it with the bank. Now, what if you got no money and you need to go to the bank and borrow? Now, I'm just giving you an example that these are the rates published by Maybank. So you can see the base lending rate is about 6.65% per annum. You notice I mentioned to you that there's BR, BLR, BFR, and so on. So the base rate is about 3%. Now, the last line shows the indicative effective rate. If you take about a 350,000 housing loan for 30 years, the bank is going to charge you somewhere around 4.15%. Okay, If you go to buy a property, a house, and you're going to take a housing loan, we've just seen earlier that the rate is about 4.15%. Now, what if you're going to take a personal loan? Now, what's the difference between a personal loan compared to a housing loan? Now, personal loan usually is unsecured. That means you go to a bank and tell bank that, yeah, I need to spend a bit more money this month, so I need extra cash, 20,000, and I'm going to pay you back in 3 years time. So the bank look at you and say, okay, you've got a good job, we're going to give it to you, and they're not going to ask for any security. Now, unlike a mortgage loan, they mortgage your house, meaning if you can't pay for your housing loan, the bank can sell your property and take back the money. So housing loan is more secure to the bank, but personal loan is more risky to the bank, so the bank is going to charge you more. Now look at the interest rate. You take a personal loan, you can see over here that it says it's around 8%, 7 or 6.5%, and in fact you can see the bank is lowering the interest when you borrow more. Now that's because the bank is hoping that you take a bigger loan and they can make a bigger profit. Now, even though you see like, oh, the interest is only 6.5%, it's not too much different compared to the housing loan that I've got, which is around 4.15. Now, take note, if you see at the bottom of this table, it says that the effective interest rate may vary from 11.53% to 14.68%. Now, why is the interest rate stated at 6.5 to 8%, but at the bottom it says effective is 11 to 14.6? Why is there a difference? Now, which exactly is the interest rate that I'm paying? Now, you have to understand, when the bank quotes the interest to you, in most time they only quote you what we call the annual percentage interest, and the bank does not quote you the effective interest. The effective interest is the interest you're actually paying, and the annual percentage interest is just the interest that they say that this is the interest rate that they're going to use for a year. But the problem is the effective interest rate is being compounded. Now that's because when the bank calculates the interest, the bank compounds the interest, and the way the bank compounds the interest will depend on whether they will use it on a daily basis or monthly basis. So sometimes it sounds like very nice when the bank say, hey, we're giving you a loan and we're charging you a daily rate, we're calculating the loan interest on a daily basis. And some people say, oh, the bank is so nice, they calculate on a daily basis. But please take note, if they compound on a daily basis, the effective interest rate can be even higher. So now you see how banks